Today, I am joined by Mike Bristow, CEO of Procured Property. Welcome, Mike.
Hi, Ian. Great to be here.
Thank you for joining. So today, what we just wanted to pick up on was, given the current uncertainty and volatility that we're seeing in the market, is around how different lenders are funded and how that might benefit developers going forward. So first thing I wanted to pick up on was how banks are traditionally funded. All the banks are generally basing themselves off a SONIA or Bank of England base rate, and they're tracking that line. So as those rates go up, then obviously your cost of funding goes up. You then have funds that generally tend to have a fixed cost of funding for a certain period of time, which then once that is evaporated, then it gets repriced and new money's drawn. So that again gives a bit more certainty. And then we've got Crowd and Mike, obviously slightly different model again. So just wanted to explore the three models that we really see in the market, the benefits and advantages and disadvantages of each, and really how you see them weathering the potential volatility or uncertainty that we have next year. Sure.
I'm going to step back just 1 second and set some context here, because for many years, I think property developers and investors didn't really think about where does my funder's funds come from, right? It sort of disappeared post 2009 as sort of things started to settle. It was sort of like, it'll be fine, right? But COVID really exaggerated this point, right? So you hit April, May 2020, and suddenly people start pulling out of the market, right? Banks and non-bank lenders stopping funding, right? And some of the big development lenders did exactly that. And I won't name names, but there were surprisingly a lot of them that just stopped. Now, that wasn't just reneging on offers, right? It was also stopping drawdowns on projects, right? Which basically destroyed projects, right? We know because we refinanced a hell of a lot of those, because we were reliable funders throughout. So in that context, why did that happen? Right? Well, firstly, typically banks will retrench first, right? That is effectively their own balance sheets of FCA and PRA regulated savings deposit banks, and they'll say, right, I'm pausing. I'm just going to watch the market for a bit, right? And however, also banks access the markets as well for that funding, and they see that moving in price, moving in cost, moving in availability, right? So there's a few factors around banks, but generally very conservative segment of the market, right? Then you have the sort of the other pool that we are as well, so non-bank lenders. Now, the key here, and I think that people don't really think about until they reflected upon the COVID situation, is that non-bank lenders get their capital from somewhere, right? And that's typically from what's called wholesale sources of capital. So major lines from typically major asset managers, big banks, etc., that will say, hey, look, I don't want to, with my capital, I don't want to deal with developers and originate deals, etc., right? But you as a non-bank lender are good at doing that, right? So we'll put capital your way through funding lines, and you deploy that, you report back to us, etc. The issue here is that segment, often those non-bank lenders have a single source of wholesale capital, right? And therein lies the absolute fundamental problem, right? So imagine you're one of these, and they're not household names, one of these wholesale capital providers, right? And you've got many, many different asset exposures, right? And in April 2020, May 2020, part of your book is invested in listed equities, and that goes volatile, right? And asset managers do not like volatility, right? So they say, right, pause equity capital investment, and whilst I'm at it, pause everything so I can just step back a second and reassess where I'm deploying, right? And that is the issue with the single source of wholesale capital. You are liable to that attitude. Whereas we've built our business off the back of a strategy of diverse sources of capital, right? Major global asset managers, banks, family offices, smaller asset managers, and private investors through our platform. Okay, and all of those different sources, right, enabled us to fund perfectly through COVID when very few actually did, right? And actively fund in today's market without a concern that any funding will get pulled, right? And therefore we cannot deliver perfect reliability to our developer customers. That is what developers want: speed and certainty, right? Few other things as well: ease, transparency, expertise within the lender. But at the end of the day, speed and certainty is so powerful, right? And that certainty of capital. And so through 2020 and into 2021, and exactly right now, developers are challenging their lenders, asking better questions about where the capital comes from, right? And what you need to see as a developer is a backer that has diverse sources of capital and proof to be perfectly reliable through COVID, because in other troubled times, they will be perfectly reliable as well.
Cool, that's great. So with your sources of capital then, so we've got multiple funding lines, the sort of presumably the major piece of the initial stack. So like your look through on that might be 80-90%. And then the top up is from more private investors and family offices.
Well, it comes right across the board. Right.
Okay.
That's the point. And that mix may vary, right? But that's the power of diverse sources. Right?
I think that's one thing actually that a lot of people don't realise is actually the capital stack is as relevant, or is exactly the same on lender side that is on the borrower side.
Yes.
Is that you have got different layers. So yeah, no, it's something I think gets people miss. But okay, good. And so we, generally as a lender, you think that all of your sources of capital, or you have enough diversification that, if one funder decides to actually, they don't want to be in this market anymore, you still got plenty of cover.
Very much so. However, the contractual structure of our funding lines is so powerful, built on so much expertise and experience closing those funding lines, right? That actually, this is not most non-bank lenders have funding lines that kind of aren't really funding lines. They're kind of yes, we have an ambition to lend 100 million through you, 200 million through you, but we're going to see every single deal and we're going to
it's a warehousing facility,
right? Yes, double underwriting, right, which slows the whole thing down. Yeah. Ours is what's called discretionary funding line, right, where they back our expertise, our due diligence, right? So there's only a 1 point of underwriting, right, and that is a strategically entirely different commitment of capital, and obviously to deliver on that, those asset managers have done is poured all over our business, right, seen best in class right across the board in terms of our expertise, our technology, our underwriting processes, our policies, etc., right, and that's that's delivered by 8 years of building this business, but also resourcing the business well. We have a team of 55 here, which is a substantial resource base for a lender in this market, because we have big ambitions to build the systems and processes, and that doesn't include our 10 that are sat in Sydney, on Australia, and the market we've opened up there for us. So those are the other factors, right? We're well resourced, so we can serve those customers better, like support through the process.
Just to what I'll do just quickly is just to explain that to anyone watching. So what Mike's explaining there is difference between a lender where they have the discretionary funding arrangement. So what tends to happen is a framework is agreed between the funding line and the front of house, if you like, where they agree very strict parameters in terms of as long as it meets these requirements, then this funding can be advanced without having to get acknowledgement from us. The flip side of also the alternative is what we just termed loan warehousing. So it's where I underwrite the loan as a lender, and then I go off to other people that sit behind me. So I might have different sources of capital, and then I try and offload that loan to those sources of capital. So I keep the loan on my balance sheet for a very short period. But the issue that you have there is that, as Mike said, you have a secondary underwrite, which just slows down things enormously. So if you've ever been to a lender and they've gone, yes, 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 and then a week later, it's no, 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 sorry, we can't. That's probably how they're funded, because they've overstepped their own, or they've been a bit overconfident on their ability to execute with their funding lines. So,
exactly, and the vast majority of the non-bank lending market are exactly structured like that.
Yeah,
okay,
yeah.
Which is a weakness.
Yeah. Okay, cool. So that's really good to understand that. And I mean, coming into a period of uncertainty, we've covered the fact that you feel the funding lines are secure and there's no problems there. So how does your approach internally change as a lender? Because normally you'd expect lenders perhaps to be less aggressive. Perhaps they're going to be a bit more diligent in terms of their underwrite. How might you see your processes change during this sort of next 18 months, 2 years?
Yeah. So first and foremost, there's a couple of points here. So if, and probably we enter a technical recession. And unlike recent commentary, we're not in technical recession yet, because GDP figures for Q2 got revised from crucially from minus 0.1% to plus 0.2%. So we've got
at least another 2 quarters now until the recession.
So at least on a technicality, we're not in recession yet. But look, that's the direction of travel, right? But what does that mean? So a recession will mean there's less consumer confidence out there. Right, there's typically less capital out there, and leverage may be not as freely available. However, there's a lot of capital out there in the market. There's a lot of dry powder capital looking for home. This is a very, very different environment to 08, 09. Right.
Well, I think that's part of the problem, right? Is that actually there's too much liquidity. That's why we have the sort of built up to the place we are today.
Yeah, but a recession which could drive a softening of the demand side for property does not suddenly mean that drops below the supply side shortages and the supply side constraints, right? And so I think what we'll see is we'll see different dynamics on the property market than the overall economy. And it's no secret at all that we don't build enough homes, and that's a material part of new transactions or transactions each year. And so supply side is down, and we still see that data on the portals right now, despite the fact that demand side is coming down. Okay, and that's interesting, right? So we fundamentally need to build more homes. We set this business up to fund small and medium-sized developers because we didn't feel that the development finance market for that segment was good enough or even good. So that's where we stepped in to support SME developers. That is what our funding lines are committed to. And we are committed to fund small and medium-sized developers that are vital for supply into the market and also spend in the economy. You know, if you think that each home built is worth £100,000 of spend on labour, materials, and services in the economy, then dropping off house building is catastrophic for economic outputs. Right? So we shouldn't conflate recession with property price fall, right? Because of that supply demand balance. It might, but I think it will be moderated if it does. Right? That's really important. The other thing we shouldn't conflate is material cost inflation and the cost of living crisis. Right? Material cost inflation has been around for over 2 years. And that is now much more certain and coming down. If you look at lead indicators such as the US lumber futures market, okay, which is a market I've personally got infatuated by. I didn't think I would ever, but hey, it's my new thing. Then look, lumber futures, which is a really good lead indicator, are having seen big spikes in 2021 or late 2020, 2021, and very early 2022 big spikes. That's now down at 2019 levels, right? Yeah. So material cost inflation is much more predictable, right? And it's much less volatile, and it's at much lower terms. It's pretty much at pre-pandemic levels. Right? That's interesting. Now you still have to sort of buy energy to build holes in the ground, for example, right? So you know there's sort of still impact of energy prices, right? So there's a few things here, okay, that say that the way we look at this, right, because we're not linked to, say, small and medium-sized business lending like banks would be, right? We're not linked to equity markets. We're not linked to many, many different other asset classes. We're a specialist property development lender. We're in the market to fund property development, and we are as active now and today as we are as we have been. In fact, this last quarter was 90% up on the same quarter last year in terms of lending. So we're in the market, we are lending, and we are not, and this is important, raising our rates like we're seeing across the markets. Right? So now, yeah, so I'm going to come into the price piece that you sort of mentioned earlier. Now, we always observe, well, and again, part of the reason we set this up is because this sector has always been raft with hidden fees and devious tactics and things. And the sort of the pricing tactics that are coming into the market are pretty much across the board now. It's SONIA plus, base rate plus, right? We're not SONIA plus and base rate plus, because the danger of that, and this is the reality in a SONIA plus and a base rate plus offer, is that that's not fixed at point of offer, it's fixed at point of completion. So you've probably got 4 months, 6 months if you're working with a slow lender of exposure to base rates, right? So even though it's theoretically fixed, it's actually not in the interim until you complete on that loan.
The majority of lenders don't even do that. They ride out the costs throughout. So if base rate or SONIA increases during your loan term,
yeah,
the margin is fixed, but actually the overall cost is not.
Well, yes. So that's the other thing. That variability remains, right? So that's the other model. It's variable pricing. So there's sort of fixed that isn't really fixed, and there's variable that is variable by definition, right?
Yeah. What we're seeing some lenders do actually is price in like a 15% additional headroom on interest retention. So that then is giving a much smaller land loan on day one, because they're pricing in that future uplift in pricing. So again, your model doesn't, and other fixed lenders don't need to do that, which is a big benefit at this time.
And that's definitely right. So others might be fixed, but they're not necessarily fixing it at point of offer. they're fixing at a point of completion of the loan, right? So that, you know, these are great examples, and that 15% additional retention are great examples of the nuances that people put in, that it's very easy to look at headline rates and not factor these in. And
100%. And that's the reason we're trying to do what we're doing on the platform, is to give that complete transparency to people, to show them that actually you're not comparing apples for apples. You know, you're comparing apples and pineapples, you know, most of the time. It's very, very different. And I think if, you know, for a novice, for people coming into the market, and even if you've been a developer for 20 years, chances are you're probably only drawing one loan every year, 2 years. So actually, you know, the speed of change and speed of volatility in the current market is huge. And so, you know, from 1 month to the next, there's big changes. So from 1 year to the next, those changes just amplified. So I do think it's really important for borrowers, you know, at any stage, any level of expertise, to be really understanding, getting under the skin of how their lender's funded, and also how they price.
Exactly. And we've been developers ourselves, right? And the most important insight there, you know, we built this model as property financed by property people, right? And the most important factor here, other than knowing exactly what developers really need from their finance partner, right? Partner being a key word, okay, is that property development is stressful, really stressful, because they're projects, and a load of stuff goes wrong, right? By definition. So it's constant stress through a development project, right? And what you need to do as a developer is take uncertainty out, take stuff that can add to that stress out of the equation, right? And therefore, in our view, going with variable or these sort of faux fixed type models, well, that's just additional stress you could do without.
Yeah. No, I agree with that. It's all about controlling the variables, isn't it? And I think especially coming into this sort of current economic uncertainty, I think the more you can de-risk, the better. So, you know, fixed costs, you know, are a massive win at the moment, I think. Okay, so but in terms of how you might approach your underwrite, you don't think, because I think we touched on obviously material costs, you know, coming down, which I you know, I've seen the graphs and the trends that you're talking about. What I guess I'm looking at is more cost of interest, right? So, you know, if I'm looking at mortgage rates, I saw a rate card from a lender at the end of last week, where they're offering buy-to-let fixed rates at 7.5%, whereas 3 months ago they're offering at 4.5%. So, I mean, that's a material change, and obviously most developers are still selling, but even if they're looking to refinance at 7.5%, it doesn't cover the debt quantum that we're used to historically. So if you're borrowing at 65-70% loan to GDV, you're not going to be able to get out on a refinance. The best you can hope for is sale and part sale, part refinance. But is the market going to be there on sales? You know, how, you know, what's your view on that? You know, how do you see that sort of affecting, you know, the exits?
I think reading what has come out in the last 2 weeks is not indicative to where things will be in a year or two's time, right? We saw a major shock of a poorly communicated and underestimated impact of some budgetary policies that wanted to stimulate demand, and I'll leave. I won't move forward on that thread with my viewpoints on it. Okay, but we've seen that unwind. We've seen sterling strengthen against the dollar, and we've seen interest rate futures come down. Right.
Yeah.
So right now there's a hell of a lot of flux. Okay. So and there will be people needing to agree to products right now, and the uncertainty heavily priced into products on the market at the moment. So that rate card being a good example there. that could have already changed from Monday if you saw it on Monday, right?
No, I agree. Yeah.
So I think, as with many things, and the overlay to all of this was this, this was sensationalized in our wonderful media. And you probably get a load of algorithmic trading that exaggerates market movements right now anyway. So there's so many dynamics at play here, and what markets don't like is uncertainty, right? They really dislike uncertainty, right? And what needs to be brought to the market is certainty. So the modeling of impacts, the modeling of things, the sort of all the analysts work in private and public institutions getting a clearer view of where everything stands, and that will start to play out. Okay, so what will so right now there will be high rates quoted in the market. Okay, and whether that is because people see a pricing opportunity because there's a lot of retrenchment, or because that's how they're pricing risk in these because of the level of uncertainty, being opportunistic, et cetera, et cetera. We're not, right? We have patient sources of capital, okay, that support what we're doing and the fundamentals of putting more homes into this market, right? So whilst everyone around us is changing and lifting significantly, we're not, and we're not yet. Will that happen over time? It might do, right? And I'm not ruling that out, okay?
Sure.
But what we can do is be a great support to property developers, and in particular, small and medium-sized property developers.
Mm-hmm. Yeah, I mean, I think my own view is that I think rates will spike quite quickly and get up to some pretty scary levels early part of next year. But I also think that there's a lot of deflationary macro events that are completely unrelated to our own situation in tiny Britain, and that are going to have more of an impact than what we're doing domestically. I mean, if you look at, obviously the demand for energy is falling now that Europe has stockpiled for the winter all of its gas supplies. All of that is denominated in dollar, so dollar's obviously very strong at the moment vis-a-vis sterling. So naturally, as that demand dissipates, then dollar will weaken, sterling will look better versus the dollar, and I think that, in line with what the Bank of England is probably going to do, will hopefully nip this sort of stubborn inflation in the butt, and then the bank is in a position to actually bring rates back down again, right? Because they didn't have much of a way, they didn't really have anywhere to go with rates at 0.1%, right? How do you stimulate the economy other than QE when your rates are such a low base? So I do think, and I think it's a calculated gamble, because there are a number of people on fixed rates where they will mature next year and they will get stuck at a high rate. But I think the bank looks at it and thinks, well, actually 90% of fixed rates don't expire next year. Therefore, we're going to take it up and we'll start bringing it back down. Yes, 10% of people will get hurt, but 90% won't, and therefore the market won't collapse. And that's just what I think.
And therein lies one of the sort of the key things. There are lots of indicators across the board, not only supply and demand dynamics, the ability of household balance sheets post-COVID to weather a bit of a storm if those inflationary pressures are transient. All of these sort of factors. But yes, you're right. So on the average, if the danger of averages position is that I think there's underpinning to the market that says it will be pretty benign going forward. Okay, it'll be a bit up and down, etc. Right. And this is the property market, residential property market, right? But there will be pockets of opportunity for investors and developers, and especially that will be exaggerated by about half of resi property is unencumbered. Of the other half, 90% is on fixed rate mortgages, which is fundamentally different to where it has been in the past.
Yeah.
And so therefore, actually, unfortunately, through no fault of many people, it will be somewhat of a timing lottery as to those fixed positions unwinding, the timing of that, and some people that may have not, if they're say, for example, they're portfolio landlords, and if they've locked all of those up at the same time, then actually that could unwind quickly and hard, right? Yes. That could, that such a landlord or such a landowner, etc., will be in a different headspace and attitude to the property market than someone affixed for a further 4.5 years.
Yeah,
so therein lies the pockets of opportunity, as well as you'll see some geographic pockets of opportunity with, depending on certain exposures to certain sectors and, especially hyper-cyclical ones. So, from my perspective here, I see, an ongoing opportunity and potentially exaggerated opportunity for people holding cash to invest and take up development opportunities in this market, and that is where we are facing off to, and here to lend.
Yeah. No, I agree with all that. I think there's the buy-to-let landlord that does, like you say, have all of their positions maturing at the same time. I mean, there's a big cash call there, and really do feel for them. And as you say, it is purely just a feature of when they fixed. They've done nothing wrong. They've just happened to fix at the wrong time in the cycle. And I mean, I've got 2.5 years left on my residential mortgage, and I'm very glad I have. Because I think we should hopefully be in the new normal range, maybe in the sort of 2.5 to 3.5% range, which is where I think we settle back down to. But it's going to be a bit of a rough ride. But as you quite rightly identify, with all these situations, there is going to be huge opportunity.
Yeah,
I certainly think Q2, Q3, Q1, Q2, Q3 next year, people with cash could do very well.
Yeah, but and that's exactly right. So the critical piece, therefore, just to become full circle, is to have that reliable lender behind you, and we've now backed over £600 million worth of projects, and still see that as just the beginning of our support to small and medium-sized developers. And also I'd add to that, it's not just about the reliability of capital is crucial. The cost of capital is important, but the overriding factors here is that development finance is a partnership. It's more than a commodity, and you need to have a lender that also understands what it's like being a developer, been on site, gets the fact that loads goes wrong, right? Is a proactive lender that shares sort of macro insights or supply chain insights across their book, and acts far more as a partner than just a big stick wielding financial institution. And that's really the core of why we exist.
I think the good thing about this sector is that the majority of lenders do act like that, specialist lenders. I think you're right. I think the bigger institutions, like the well-known names we all know, they're the ones where perhaps people immediately gravitate towards because they think, well, they must do this because they're a big bank. Whereas actually they do it, but they don't really want to do it. And the people that administer it don't actually know what they're doing a lot of the time. I was speaking to a developer this week who is 10 months into a project, and it's one of the big high street banks, and he still hasn't had a single drawdown. He's had to put 4.5 million of his own money in, and he's at roof stage. I mean, he's had his timber frames, he's had all his block work done, and he still hasn't had a single drawdown from that high street lender. And he's had 3 relationship managers since he started the process 18 months ago. And that is not an atypical. I probably have that conversation 2 or 3 times a week.
I find the whole drawdown piece remarkable, because I mean, we do a lot of research, and this kept on coming up. This kept on coming up, and we hadn't experienced it too bad in our developer days, right? However, if you look at it, it's insanity, right? My background was sort of 18 years of advising private equity transactions in consumer businesses, consumer goods businesses, retailers, etc. Right, where the real epitome of B2C customer focus, right, really important. And this whole sector was beautifully sort of not applying any of that absolute relentless customer focus. And the number of times we've heard about, drawdowns, at best taking 2 weeks, right? It's a drawdown, an IMS report comes into this office. It's the single most important document in the office. Why? Because we need to get that to site. And we need to do that same day or following day. Really, the only time we release it the next day is if there's a callback requirement into the developer and they don't answer their phone, right? Just to double check bank details, right? But it's crucial because the success of the site relies so much about the human beings that are on that site, the contractors, the subcontractors, etc. Right? And the best way to motivate is with cash.
Yeah, right? and that's the thing. I mean, everyone should be aligned, right? You all want the same outcome. Lender wants their money back, wants the scheme delivered successfully, and by not allowing the money to flow in the right timeline, you are throttling the potential success of that scheme. So it makes no sense, but it is very normal from what I'm told on a frequent basis. That these things just it's not joined up. So no, it's great. Look, I think you guys are doing a great job, and I think there are going to be plenty of opportunities for good lenders and good investors and developers to profit from what unfortunately is going to be perhaps a bit of a rocky ride for the next 6 to 12 months and maybe longer.
Yeah.